It is a roller coaster right now as it pertains to the rate market for mortgages. So let's talk about it. Friday and Monday, we already talked about rates coming up as a result of inflation numbers. Not a good day, Friday and Monday. Tuesday, things were relatively flat. Wednesday, yesterday, Fed came out, increased the Fed rate by 0.75. They were predicting 0.5. Last meeting they had forecast, I should say, 0.5. They increased by 0.75, more than expected, although they did leak a story everybody believes the day before to warn the markets of that, so there wasn't any kind of big shock. They also are predicting now another 1.75 of rate increases through the end of the year. So that was all news that you would think would cause rates to go up, right? Well, in fact, a lot of those rate losses we had with the increases from Friday and Monday, probably 3/4 of that were erased temporarily yesterday after the Fed made the announcement. So why is that? Well, just confidence. People liked the move by them. Some mortgage-backed security dorks out there, you're going to be like, that's not the way it works, but don't get your 5% coupons in a bundle here. I get it, but let's talk to the only 5 people who will probably watch this video who have no idea what you're talking about when you talk about mortgage-backed securities and yield curves and inverted this and blah, 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 right? So to those 5 people watching, mortgages are forward looking. So when mortgages look and see, hey, the Fed made a move that we think is good long-term for the economy, this is long-term debt. Long-term good moves by the Fed made the rates drop down a little bit because confidence in what they were doing increased. So that was great yesterday. Very temporary though, because today, now the world is worried about inflation. We have the Swiss, who are very conservative, come out. They increased their benchmark rate. We have Brazil. They have increased their rates up over 9% this year. They're up in 13 and a quarter territory. We had England, we had the UAE, we had Taiwan. All of these places, a lot of others as well, increase their benchmark rates because now the world is concerned. So that's a problem. That now we got back some of our losses in interest rate from Friday and Monday on Wednesday for a short period of time, and then we lost them again today because the world now is concerned. So I should say, I guess the rates are still higher than they were this time last week, but not quite as high as they were at the end of the day on Monday. They went up, they went down, they went up again, just didn't quite hit the peak, but they also didn't come quite far down enough to come back to where we were at the end of last week. With that said, we've got a couple other numbers that came out today. Housing starts were down. Builder confidence is down. That means supply, right? We have builders building less and starting less. That's going to reduce supply. Not really great for the situation we're in. On the opposite side, we did have building finishes up. So that's good. There's at least some more supply in now. And buyer demand was down, which we would expect because the interest rates have gone up and therefore some people have left the market. So stay tuned here. We'll give you some more information on Monday, give you your next update. And if you found any of this stuff useful, like, share, comment, follow, subscribe, wherever you're listening to this to, and tune back in here on Monday for another update.